Good morning, everyone. You're very welcome to this morning's webinar about our new short course that we've recently launched, Advanced Tax and Estate Planning. My name is Denise McLaughlin, and I am part of the team here in LAA. So having developed and delivered the content for this course, I'm delighted to be joined here today by David Clancy, Managing Director and Founder of Clancy Associates. With a wealth of experience within the tax industry, David has become a leading industry expert in tax and estate planning. So if you want to just move on to the next slide there, David, thank you. So just in terms of what we'll be going through during the webinar, I'll be giving you a high-level overview of the course delivery and logistics, and then David is going to take you through an overview of the course content, who this course is tailored for, the modules in the course, and I suppose what you can expect to take away from the course. And then towards the end, there'll be a Q&A for any questions that you have. So just in terms of the course delivery then, it's available on demand, and that just means that the lectures are pre-recorded and you, can be completed in your own time and at your own pace. So then at the end of each module, there will be a short quiz, and that will just test your knowledge. There will be 5 modules to complete in total. And those that complete the course then will get 4 hours CPD if you have an annual CPD requirement. So that's towards your LAA CPD requirement and your CFP CPD requirement as well. You will also get a certificate of completion from LAA once you complete the course. And then just in terms of cost, the course is €600 for LAA members and €700 for non-LAA members. Registrations are now open for the course, and more information about that will, like how you can register, will be covered towards the end. As I mentioned there, if you do have questions throughout the webinar for myself or David, please feel free to just pop them into the Q&A box there at the bottom of your screen, and we'll get to them then at the end. So I'll just pop you back over to David now, and I'll be back for the Q&A. Thanks.
Good morning, everybody, and welcome to the session. I suppose in relation, when the LAA approached me in relation to this course, I was given kind of a clean piece of paper, right, to actually think about what are the key, basically, areas that financial planners are facing in the tax world. Okay, so what we did was we strived to look at those key areas, right? Okay, and to devise kind of a very highly practical course, right? Okay, focused on those key tax issues for clients, and to provide you know, financial planners, right, with knowledge, right, and strategies to help basically clients in dealing with these key tax areas. So to give you some examples of the areas that, you know, financial planners are continuously asked about, right? Okay, you know, clients are wondering whether they should transfer wealth during their lifetimes or wait and do it by way of will on death. Obviously, there's various tax issues arising in terms of that decision. There's various risks associated, right, with doing it during lifetime rather than death. And there's various tax advantages of trying to basically do it during lifetime to get future appreciation in the hands of typically children. Okay, you know, during the course we look at some structures, right, that will help people, you know, assist them in relation to transferring during lifetime the likes of family partnerships, which allows them to keep an element of control in relation to it. Okay, other areas that, you know, essentially financial planners are asked about is whether they should hold property personally or through a company. So there's various tax issues associated with the holding of property personally from an income tax point of view versus in a corporate, right, where a corporate holds property and is liable to corporation tax initially at 25%, but then a closed company surcharge of 20%, which gives you an effective tax rate of 40%, and you still haven't got the money out of the company, right? Okay. So again, one of the key areas would be in relation to capital gains tax, where you're holding it personally, one hit the tax, where you're holding through a company, typically two hits to tax. So again, looking at other areas associated with it in terms of important reliefs, like retirement relief and business asset relief in terms of the holding of those properties. So again, the overview, right, in relation to the course is very, very, very focused, right, okay, on practical issues that financial planners are faced with in terms of clients raising key areas, right, in relation to their financial affairs, okay? So, the course is very focused on financial planners, right, in terms of assisting, right, the financial planners in relation to provide knowledge and strategies, right, okay, to help them in terms of advising clients in relation to these key tax issues. So to give you a kind of a flavor of the modules, okay, so one of the areas that is key in relation to the Irish tax system would be the scope of Irish tax. So what are the key drivers for clients in determining the extent of their liability from an income tax, from a capital gains tax, from a capital acquisitions tax, from a stamp duty point of view? Okay, so those drivers, right, we'll dive into them in a lot of detail in the course. We look at residence, ordinary residence, and domicile, and look at the implications from an income tax, from a capital gains tax, and from a capital acquisitions tax point of view. We look at the key relieving provisions, right? Okay, and again, that's a focus in the course, right? To look at key reliefs. So in terms of the key reliefs, it could be for people coming in or leaving the country, right? Where there's split year residence in relation to the year that they come or the year that they leave. In relation to people coming from associated employers to work in the Republic of Ireland, there's a special assignee relief programs. We look at SARP, okay, and in relation to people going overseas, right, where they're working in qualifying countries, okay, and they're resident in the Republic of Ireland, there is foreign earnings deduction. So we look at those key reliefs, okay, and I suppose one of the features of the Irish tax system would be the remittance basis for non-domiciled individuals. So we'll look at planning for those non-domiciled individuals in relation to remittances from both an income tax and a capital gains tax point of view. Okay, we'll look at double tax agreements. Okay, so again, in relation to double tax agreements, where you've got a lot of clients, right, either holding assets, right, or in receipt of income, right, from overseas. Okay, you've got basically double tax agreements, which essentially lay down the rules, right, in relation to how that income is treated from a tax point of view. Okay, you've got people coming to the Republic of Ireland, might have tax residence in another country and tax residence in Ireland. You might have people leaving the Republic of Ireland, become resident in another country, but still retain ordinary residence in the Republic of Ireland. We look at the rules, right, in the tiebreaker clause of the treaties to determine who gets primary taxation rights. And we'll see in the course the double tax agreements override domestic legislation. So we look to see who gets, primary taxation rights. We look at kind of the key, income sources, right? Okay, whether you've got, dividend income, whether you've got pension income, whether you've got capital gains, and we'll look to the treaties, right, under the model treaty, the OECD model treaty, to determine who gets the primary taxation rights. Okay, So very focused on planning, right, okay, in terms of looking at angles, right, okay, in relation to people coming or leaving the Republic of Ireland. Again, very mindful of anti-avoidance legislation, right, in the code in relation to people disposing of shares, right, okay, and going temporary non-resident coming back into the Republic of Ireland. So a very practical review, right, of the scope of Irish tax, okay, and a practical, review in relation to planning for individuals both coming to Ireland and leaving the Republic of Ireland. Financial planners, right, essentially are often involved with people selling their businesses or looking to hand down their businesses, typically from one generation to the next. Okay, so the module starts off with a deep dive into looking at the issues around capital gains tax, capital acquisitions tax, and stamp duty. Okay. Again, big focus, right, on the reliefs, okay, in relation to retirement relief, entrepreneur relief, participation exemption in relation to holding companies disposing of shares in trading subsidiaries, okay, business asset relief, right, where you got business assets being transferred where 90% of the asset value is ignored for tax purposes, provided certain conditions are achieved. And again, in terms of the agri sector, looking at agricultural relief, where agricultural assets are transferred to an artificially defined farmer, right, okay, and provided basically there's retention, 90% of the agricultural assets are ignored for tax purposes. Again, a lot of change in these areas in the likes of changes in retirement relief in terms of age, in terms of the amounts in relation to that you can transfer, particularly to children, right? Okay, with some amendments in the last couple of years that are critically important for financial advisors to be aware of when advising clients in relation to transfers of family businesses to typically their children or to family members. We then look at the area of company buybacks. Okay, so again, looking at how company buybacks can be used by financial planners to get really tax efficient results. Right? Okay, typically it's around where you've got an exiting shareholder, right? Okay, and you're looking for conditions to be achieved to get CGT treatment in relation to a company doing a buyback as opposed to distribution which is liable to income tax. So typically we're looking to do company buybacks and see can we marry them with either retirement relief or entrepreneur relief, and the module will go through that in quite an amount of detail. A lot of the sales of businesses, right? Okay, there can be often, right, a reorganization completed, right, from a tax point of view, okay, before basically the sale, okay, and again, we'll look at basically how and why these reorganizations are done and the tax efficiencies associated with the reorganizations. Okay, I think if you ask any tax advisor, right, okay, at the moment, one of the key one of the key sentences in the tax world at the moment is that transactions are being done for bona fide commercial purposes and not for the purpose of the avoidance of tax, right? Okay, so again, we look at some cases, and I can't emphasize enough for financial planners the importance, right, of essentially the lead with commerciality. There's about 60 provisions in the tax code in Ireland, right, okay, that have that provision around bona fide commercial purposes. So it's one of the key areas at the moment. And again, from the cold face, right, okay, some direction there in relation to case law and key things to lead with, right, for financial planners in terms of ensuring that the relieving provisions are achieved, right, okay, in relation to that. So very much practical focused, right, okay, and a planning focus, okay. So again, you know, clients looking to basically do basically transfers, right, okay, either sale or a hand down in a tax efficient way, right, okay. If it's done properly, you know, you've got capital gains tax at 0 or 10%, as opposed to headline rate of 33. And again, from business assets and agricultural assets, again, if it's done properly, rather than have a headline rate of 33, you have an effective rate of 3.3, where 90% of the value of the assets are ignored for tax purposes. Again, you know, given the demographics of clients that a lot of financial planners are dealing with, right, estate planning is become more and more basically important, right, okay, in terms of advising your client base, okay. So we'll start off again by looking at a quick whistle-stop tour in relation to capital acquisitions tax, in relation to the scope and the rules, right, okay, in relation to capital acquisitions tax. As I said at the outset, one of the key areas for clients to get their heads around is, you know, what do they do, right, okay? Do they do it basically during lifetime, or do they do it during, you know, by way of will, right, at death? So again, we look at basically some of the tax issues and some of the practical issues, right, okay, associated with essentially that decision, okay, and some structures to help people, right, okay, you know, in relation to maybe achieving an element of both, right, okay, where they give but they retain control, okay. We'll, you know, all the time clients are interested in essentially ensuring they're being as tax efficient as possible. You know, in this area, what you don't want is multiple hits of tax. So you don't want capital gains tax followed by capital acquisitions tax. So we'll look at the likes of offsets, we'll look at the likes of exemptions. You know, again, you know, I mentioned business asset relief and agricultural relief. One of the other important reliefs, right, okay, is in relation to dwelling house relief. So again, looking at the conditions, right, okay, and again, identifying where it's really, really key, right, okay. We'll see that later on in one of the modules in relation to people who are cohabitating, right, okay. The dwelling house relief can be really, really important for that category of client. So one of the features of the system right over the last number of years has been the use of loans, okay. So we'll have a deep dive into the capital acquisitions tax, right, legislation in relation to the free use of money and the free use of property, right, in section 40 of the CAT Act, okay. And then we'll have a look at why people use trusts, right, okay. You know, some of the tax issues associated with basically the trusts, right, okay, and, you know, some practical application of why people would use a trust. So for example, right, where they might have a child who is not well, right, okay, you know, might have special needs, right, the discretionary will trust, right, is the boilerplate you know, solution for a financial planner to consider, right, with the client in such circumstances. And we look at disclaimers, right, okay, again, can be useful tax planning tool, right, okay, in certain circumstances. So this is where you put your hand up and say, thanks, but no thanks, I don't want the benefit, okay. So again, just looking at ensuring that your school bag is full of basically techniques, right, to help clients, right, with specific, basically, issues in terms of providing solutions. Okay, and this was one from the cold face, right? Okay, where I sat down to look at what is key, right, in the tax world at the moment, right? So what's coming across basically our uh, you know desks as tax advisors working with financial planners, right? Okay, with clients. Okay, so at the moment, right, we're seeing lots of basically issues in relation to tax issues around married couples, right? Okay, tax issues in relation to where you have relationship breakdown in relation to separation and divorce, right? Okay, and you've got a cohort based on the last census of about 161,000 couples, right? Okay, I would suggest there's more in this country, right? Okay, who put their hand up and said we're cohabitating, right? Okay, and to look at the special tax regime that applies, right, in relation to that cohort. Okay, so where you have people who are living together for years and years and years, and essentially one of them dies, right? Okay, they've got a €20,000 tax-free threshold. So our law treats them as strangers, right, for gift and inheritance tax purposes. So again, looking at some of the issues and the solutions in relation to that. Okay, I suppose again, if you're talking to tax advisors at the moment, one of the features of the system is the quantum of revenue interventions. If you look at last year's report, okay, revenue did about 301,000 interventions. Okay, so in any man's language, if I reckon, and this is just me, right? Okay, looking at what the Irish self-assessment system looks like, okay, I'd say there could be about 1.2 to 1.5, right? Okay, million in that system. So take out all the PWE workers, take out the young and the little old ladies, right? Okay, I think you're in at 1.2 to 1.5. So what does that say, right? When 300,000 of them, right, are pulled for review, right? It's saying that you have a 1 in 4 or 1 in 5 chance of one of your customers, or indeed yourself, right, okay, being pulled, right, for a revenue intervention. Okay, so we look at the revenue interventions, the issues that they're focused on, right, in relation to those interventions, and some, again, practical advice in relation to dealing with an intervention. Again, one of the areas that, as part of intervention, and has been very highly profiled in media and in public accounts committees over the last couple of years, has been this whole area of employed versus self-employed. So how do you distinguish between employed and self-employed individuals, right? Okay, so we look at some of the non-tax reasons that are important, whether it be pension, whether they would be PRSI related, right? Okay, to the tax, basically, factors to distinguish, right? Okay, with employed versus self-employed, and some commentary around recent cases, including the Domino's case, which ended up in the Supreme Court at the end of 2003. Okay, then one of the areas clients are continuously asking about is how can I ensure that my remuneration that I'm extracting from a business, right, okay, or the wealth that I'm taking out of a business is as tax efficient as possible. Okay, so again, deep dive in relation to a review of benefit in coins, right, whether they be cars, loans, right, okay, or other assets, right, and different ways of taking basically essentially remuneration out of a company tax efficiently. So very practical from the cold face in relation to issues that clients are essentially asking us about. Okay, and again, in relation to investment income, okay, a deep dive in relation to the tax of rental income. Okay, so looking at what income is taken into account, what expenses you can offset against the income, right? Okay, looking at interest income, dividend income, and foreign income. So where clients are in receipt of, dividends out of the United States and Canada, right, out of the UK, what's the tax treatment in relation to the dividends, okay? And what's the position under double tax agreements in relation to that foreign dividend income? Then look at the very difficult area of the taxation of offshore funds. Okay, so a lot of clients essentially make an investment under the umbrella of a fund, right? Okay, so we'll look at the tax treatment of good funds and bad funds, right? Okay, and some advices, right, in terms of changes that might be happening in relation to the tax treatment of those funds. Okay, one of the key areas that clients ask us around is property. Okay, how should I hold it from a tax point of view? Right. Okay, should I hold it personally? Should I hold it through a corporate? Right. Okay, what does that mean when I go to try and claim reliefs, right? The likes of, retirement relief, entrepreneur relief, business asset relief, right? Okay. So what are the implications of holding property from a tax and a financial point of view? And again, very practically driven, right? Sometimes, a lot of people are forced with essentially acquiring the property through the company, right? Okay, irrespective of the tax advice, because, right, the finances in the company to allow them to acquire the property, the tax leak associated with taking the money out to buy it personally, right? Okay, is just too big, right? Okay, so therefore they buy the property through the company. And the last one is a bit kind of, where I'm a big believer around the importance of communications for financial advisors and in relation to tax advisors. Okay, so probably one of my biggest client, right? Okay, he has a mantra, right? Clancy, if you can't explain it in one page, right, I'm not reading the second one, right? Okay, which you might look back when you look at all of the technical aspects of tax. Okay, so I can have reams of basically risk protection in terms of support, right? Okay, but how do you communicate, right, with a client, right? Okay, cleverly, right? Okay, how do you listen to a client, right? So communication is not just about basically one way; it's a two-way, right? Okay, so this was something that I thought was important, right? Okay, in relation to including as a practical feature of the course. Okay, so again, in relation to it, very, very practical, client focused, relevant issues, right? Okay, that we're facing on a daily basis, right? Okay, so what can you expect to take from the course, right? Okay, so again, the focus on it is I wanted it to be practical, right? Okay, I wanted it focusing on the key tax issues. So there's a 3,500 page piece of legislation, right, just for income tax, capital gains tax, and corporation tax. There's another tome in relation to capital acquisitions tax, right? Okay, what I wanted to do was I wanted to really basically get focused on key areas, okay? Scope of tax, people coming into the Republic of Ireland, people selling or handing down businesses, people estate planning, right? Okay, key basically tax issues that are hitting our desks at the moment, right? Okay, and the taxation of investment income. When clients come, basically they want to know what is the tax implications of a particular course of action with regard to their investments. Okay, so very practical focused, right? Okay, providing uh, you know financial planners with knowledge and skills to enhance basically their skill set, right? So making sure the school bag is full of relevant tax information to allow them to apply it, right? Okay, to clients' scenarios. Okay, so again, when you look, I don't have to tell anybody who lives here, right? Okay, you know, when you look at tax, right? Okay, you've got income tax, right, at 52.1% for a lot of your clients. You've got others at 55.1%. You've got employers, right, who have employers PRSI of 11.15%, right, okay? You've got the capital taxes at 33, right, whether it's CGT or capital acquisitions tax, okay? If you can get a client to 0 to 10 to 3.3, right, okay? That's really, really important, right, okay, to a client. And, you know, I would always be of the view, right, in relation to financial planners, right, who have tax in their school bag, right, okay, that will give them a competitive edge, right, okay, in relation to advisors with clients, okay. So again, it's rapidly changing. So even in relation to some of you that might have been on a tax course with me, right, in terms of, you know, preparing for the likes of your CFP, right, okay, in terms of your professional diploma or whatever, right, okay, if you look at retirement relief, okay, maybe from the time you did the course to now, right, okay, they're two different things. So it's one of the cornerstones of the Irish tax system. So it's rapidly evolving, right, okay, revenue's view of what's important, right, okay, and you know, is key, and that you know, that updated knowledge, right, is essential, right, okay, for financial planners. Okay, so again, what I really wanted, right, to do was to give practical training, right, in Irish tax law, in relation to succession planning, and in relation to helping, right, financial planners adopting you know, tax strategies, right, that complement wealth structuring strategies. Okay, so again, I think anybody will do the course will find it really, really interesting. Okay, thank you.
That was great, David. Thank you so much for that. There was loads of information there for everybody that joined us online today as well. So just before we get into the Q&A session, if you are interested in registering for this course, you can register now through our website. And if you aren't an LAA member, you can still register for the course by creating a free LAA profile. Alternatively, if you want more information or any help in registering, you can just email us there at the education@laa.ie. So yeah, just having a quick look now through the questions. So yeah, David, you might have touched on this, but there was just a few questions there again, just on the difference between this course and the tax and estate planning module, which can be found on the postgraduate diploma in financial planning program.
Yeah, it's a good question. I suppose it would be much more focused, right, in relation to key areas. You know, so what we've essentially identified is a number of basically you know, the key areas for clients, right, okay, and you know, adopted a much more practical approach, right, okay, in terms of dealing with it. And again, as I said, right, you've got a rapidly changing environment, right? Okay, so don't think because you did, like, even if you did the certified financial planning last year, right? Okay, your retirement relief is outdated. Okay, so again, if you're sitting down with clients, that's how quickly this landscape is changing. Okay, so again, you know, much more focused, much more practical, and given the time to basically look at strategies for helping and assisting clients in developing, you know, financial plans in those areas.
Yeah, great. That's great. Someone also just asked, like, what qualifications or experience would they need before enrolling in the course?
So I suppose, you know, it is an advanced basically tax course, right? Okay. So again, it is helpful, right? Okay, if basically you have foundation stones in relation to the tax, right? Okay. So again, uh, whilst we do, and even in the first module, look at the scope of Irish tax, right? Okay. Uh, you know, and look at residence, ordinary residence, and domicile, and the implications, right? Okay, so we go back, you know, we go back and do an in-depth review of those, right? Okay, but really what the focus on is the planning, right? Okay, so again, it's certainly, it's moving up through the gears, right, in relation to tax, right? Okay, so I would certainly think, right, that you would have to have uh, at least basically, diploma level in relation to tax, in relation to doing this.
Yeah, great. And then there's just a few questions on assessment. So is there an exam at the end of the course? So yes, after completing each module, there will be a short multiple choice quiz to assess your understanding and test your knowledge of the course. So there'll be about 24 or 25 questions per MCQ exam. Someone else has just asked, is there any interaction between course participants and the lecturer on this course? For example, seeking clarification on matters presented?
No, well, there can be, right? Okay, essentially the modules are already basically have been essentially put together and taped, right? Okay, but again, if there's any follow-up questions in relation to the course, right, I will be available to review those.
Yeah, great. And then there's a few questions on the duration of the course, and this was the period of time the modules are done. So as mentioned previously, the course is available on demand. So it just allows you to go in and complete the modules at your own pace. We would recommend, I suppose, trying to complete the course within like 3 months period, so that you aren't forgetting the content that you would have learned in previous modules. Someone else has just asked how many hours CPD is awarded from completing the course. So you will be awarded 4 hours CPD. And then that's again toward your LAA CPD requirement and your CFP CPD requirement. So just another question for yourself, David. So is there much focus on people holding properties through companies, SPVs, and funding their pensions? For example, non-standard PRSAs through these vehicles. I work in both mortgages and pensions, so this comes up.
Yeah, no, essentially you've got all of those different structures for holding essentially property, but the main focus on the course has been in relation to holding it either personally, right, and the tax issues associated with that, versus holding them through basically a corporate entity, right? Okay, and looking at the corporation tax implications of holding it through a company and the CGT implications of both, and then comparing it right from both a retirement relief, entrepreneur relief, and business asset relief in relation to that. Right, okay, so it doesn't get into essentially holding the properties through pension funds, okay, or a myriad of other structures that people hold them through.
Right, yeah. And someone just asked, how long on average does it take to complete each module? So each module is 1 hour to 1.5 hours per modules. And someone has just asked, how can they register? Is it open now for registrations? Yes, it is. Just mentioned previously, you can go onto our website and register there by creating a free LAA profile if you're not an LAA member, or if you're having any trouble registering, you can contact education@laa.ie and we'll help you out there as well. So I think that is most of the questions now that we've gotten through. But if you did have any other questions about anything that was discussed today, please do feel free to reach out to us in LAA or to David. So just to wrap up, I'd like to thank everybody for joining us this morning. And I hope you found the webinar beneficial. And thanks again to David for a very informative session this morning. And just as a reminder, we will be contacting everybody about this event with a copy of the recording. So again, if you did have any questions that pop up, please do reach out to us. And I hope you enjoy the rest of your day. Thank you.